Good afternoon on our TP Minds webinar on profit splits. My name is Yves Hervé from Nero Economic Consulting. I'm located in Frankfurt. I will hold the webinar today with my colleagues Amanda Platz from our London office and with my colleague Sébastien Gonnet from our Paris office. For those who do not know us or our firm, Nero Economic Consulting is a specialized economic consulting firm advising on many economic issues, including transfer pricing. So we have a global transfer pricing practice that supports some of the biggest multinationals in the world on complex transfer pricing matters, also in cases of litigation. And profit splits are a key part of the projects we are working on, and we would like to share our expertise with you today in the course of this webinar. This is why we have set up the webinar as a very practical thing. After a short intro, we will really deal with practical case experience across certain industries, traditional manufacturing industry, financial industry, and the digital sector. Sébastien, would you like to give set the ground a little bit?
Thank you, Yves. We thought of starting with a general background about transfer pricing to get into why the transfer pricing method is likely to become more popular in the future years. So if we step back historically, compliance with the arm's length principle was very much transaction driven. There were a number of transactions with third parties, and multinationals used to set their prices based on those transactions. Slowly, with the introduction of the comparable profits methods in the US and the transactional net margin method in Europe, these transaction-based assessments have been replaced by entity-based outcome tests, which were introduced as the primary testing method. What has changed since the BEPS project, the Base Erosion Profit Shifting project led by the OECD and G20, is that it has lifted the analytical focus in transfer pricing from transaction to the context of commercial and financial relations, which are at the core of the definition of the arm's length principle. And thus, transfer pricing involves nowadays to understand how companies are jointly contributing to the value creation of a company on a global basis. And there comes the introduction of significant more emphasis on the profit split method, which exactly involves situations where two parties are contributing unique and valuable contributions to the joint parties. So that's a broad introduction of the subject, and we also wanted, and that's the next slide, slide 6, to present an overview of a holistic process that in our view should be at the start of the selection and identification of method, which is the value chain analysis process. Based on our experience, it has been an extremely useful tool to understand how companies work in a specific industry, to understand how related parties are contributing value through their functions, their assets and risks, and a very useful tool in order to properly, or I would say even more properly, assess the right selection of the method, including the profit split method. So we wanted to emphasize that yes, the value chain analysis tool is a relevant tool for the selection of method. And in the slide, we present a 4-step process that starts with the identification of the success factors and the risks at the holistic level for a whole industry and the company within this industry. Step 2, which involves mapping the functions and risks and assets of the enterprises within this value chain. And step 3, which is the assignment of the specific role and responsibilities of individual entities in light of step 1 and 2. And we trust that if we follow this process, which starts with the big picture and then get into a more detailed understanding of each entity's contribution, we are in a position within step 4 to better assess the bargaining power of the group entities and ultimately to understand in what type of deal, in what type of financial and commercial relations they would enter if they would have been in a negotiation situation. So the value chain analysis is a useful tool for selection of the profit split method, but it can also be a useful tool for the selection of any other method, not only the profit split. So after these broad introductions, I'll go back to Yves on to let us know about the most recent developments on the profit split method.
And obviously, we could spend just the whole webinar for commenting only on the latest OECD guidelines on profit split. I think this slide 7 in front of you gives you, from our perspective, the key messages from the OECD, and I would like to focus here on two particular issues which I think are relevant for today's webinar. The first thing is the OECD doesn't prescribe under which circumstances a profit split has absolutely to take place. That is still up to the decision of the taxpayer, given the individual particularities of the case at hand. It just gives some guidance in terms of where can we think of as a transfer pricing setup such that a profit split solution should be considered. And this is the first element, is when there are several transaction parties are contributing unique and valuable contributions, which means that their contribution to the entrepreneurial profit over the entire value chain is something more than what we usually call a routine profit element. So we need to have something unique on the two sides of the transactions, usually. The second is the second dimension is the interfaces between the different value contributions by the related parties is such that the ultimate customer of the client does not really know what he buys. He buys an integral service where it's not clear what he pays for, so you can't really separate what the contribution is one from what the contribution of the other is. That's the second very practical aspects to consider. And the third is deliberately for business purposes, there is to a large extent the assumption of risk is shared between the parties, so you can't say the one is more entrepreneurial than the other. It's really a joint entrepreneurial effort to lift up the business in terms of generating more money for the group. That sets the ground for a situation where profit splits are usually applied. And the second aspect I want to stress is even if that is the case, there is still a lot of individual considerations to be made in the case at hand, which kind of profit split then to apply. I won't tell you more at this stage because we will deal with practical examples later on. Slide number 8 just visualizes the first point that I raised. So for you as practitioners to have some kind of procedural tree to really view whether in your particular case at hand, your fact pattern would be such that a profit split analysis would seem reasonable. Amanda.
Yeah, so on that note, what I want to talk about is a little bit more into the detail on devising how value contribution is measured potentially within a profit split, and that's often through you often encounter it through your split factor that you would apply. Now the question is really what type of split factor, or how would you actually calculate your split factor, which is some of the complexities that we need to think about when doing a profit split analysis. And there is different types of methodologies that you could potentially use for it. We will be discussing some of them that we've used in practice. It's the ones that I'm going to be describing is not necessarily comprehensive. There may be others, but these are the ones that we've typically used. So first of all, we have potentially compensation-based split factors. Now, the idea behind this is that this focuses on compensation data, salary, including base and variable compensation of employees. The idea behind it is that it is potentially, an employee is potentially a third party to the organization, and consequently their salaries is an indication of value that that person has to the organization and the value contribution through the value chain. The downside with using compensation-based data naturally is sensitivity surrounding the data. And you are working with people's salary or compensation data, and that there is potentially a lot of influences or factors such as caps, regulatory factors. We can just think about the banker's bonus cap, for example, that could influence the data, as well as certain performance-based packages and so on that may influence this type of measure. It is a very unique and useful measure when your IP or your intellectual property is very much driven by people and the know-how of the people. Your next measure is potentially your investment-based factor or investment-based methodology. Here you typically use you can think about capitalized cost or asset-based methods. It tends to be earned internal data, so it's traceable. You do have certain issues that you may have a number of assumptions around this, and you may have certain weaknesses within your data that you use for an investment-based approach. The next approach that you would potentially have is game theoretical approaches, or what I would refer to as bargaining theory. And what this really entails is setting up a hypothetical bargaining situation where you look at what the marginal contribution is of the parties to the overall value contribution, and then through a negotiation process you are able to allocate the relative contribution of each of these entities to the marginal benefit gained from the coalition that was formed. Now, the problem with this, it is very useful throughout where other methods may not be, where other methods may have a lot of weaknesses. This is a theoretical method, and it's only as good as the assumptions that such a methodology would be based on. The next methodology is potentially using other financial data or third-party agreements or your CUPs where you have them available. This would be based on market data or potentially internal data within the firm. Again, here your typical weaknesses will be with respect to comparability issues or the quality of the data that you would use for that. This is just a very brief summary of the different type of methods that you can use to split your profits, so to speak, in an organization. Naturally, which methodology you will choose would very much depend on the case that you're dealing with and the facts and circumstances and data availability. On that note, we will be discussing 3 case studies, as Yves mentioned earlier, and within these case studies we've used different approaches and different split factors, so that will also become apparent, so there will be a bit of a practical application of how this would actually work in practice.
So we are turning now, after these broad introductions to the case studies. We have 3 cases. The first relates to the application of the profit split method for an industrial client, and I'll provide the background facts and circumstances as first. We are talking here about a multinational company that operates in a project management and delivery sector. More specifically, it designs, manufactures and installs equipment in manufacturing plants. And this company is responding to tenders, and if selected, it designs, engineers, manufactures and installs the equipment. We are in a situation where, as it is typically the case within multinational companies, a few affiliates are sharing the key functional responsibilities in relation to responding to the tender and then executing the tender. In this case, and for the purpose of this case study, which is stylized, we have affiliate A, which is involved in the design and engineering of the product, as well as host the project management team. And the project management team is very much involved in ensuring that the project goes well, including vis-à-vis the client. But affiliate B is also bringing an important contribution to the overall project because it is responsible for the production and the installation of the products at the client premises, meaning industrial clients as well, and it books sales to the clients. And the conclusion from a relatively deep functional analysis embedded into a value chain analysis is that both companies, both affiliates, had relatively key contributions both to the tender process and to the execution of the project. And in this case, for the purpose of the project, we've selected the residual profit split method. And the purpose of the case is to provide a detailed description on the application of the method for the purpose of the pricing of the design and engineering and project management services from affiliate A to affiliate B.
Maybe, Sebastian, for purposes of our audience, I mean, we see now affiliate B, I see a main functional profile, production and installation, and I think these are functions which very often I've seen benchmarked as routine functions in an industrial value chain. Can you maybe motivate why in the case at hand you believe these activities go beyond the traditional routine view on those activities?
Yeah. That's an excellent question. Thank you, Yves. And actually that shows that depending on the facts and circumstances, even if the facts and circumstances look closer, the selection of the method is not immediate or evident. In this case, the reason for selecting the method was the following. First, we are talking about an industry that involves highly complex with high technology products, and that involves a very complex production process. Products are all tailor-made and they are very specific to any project and any client. Second, we've also noticed by interviewing in-house people that there were significant interactions and interrelations between the design team and the production teams and the engineering teams to get the right product at the right time at the client premises. And thirdly, and most important, we are here in an industry which involves projects. And for those who are working in the project environment, large project with large investments at stake, they will know that this industry involves significant risks in terms of the execution and significant risks vis-à-vis the client who can impose very large penalties in case of deviation in the product specification, deviation in the time of the delivery. And further, what we noticed is that when a client issue arises, suddenly it's not extremely clear who is responsible, who can be held responsible for the delay or for product misspecifications. Is it the design team who has not necessarily provided to the production the right design? On the contrary, is it the production that doesn't necessarily ask the right questions? Or is it the installation team that has not necessarily installed in the right way at the right time? So there is an interrelation of risk, large exposure, and in this company it was decided that in fact the value species were co-responsible for the project success and or the project failure. And further to transfer pricing, that was even an incentives issue to try to incentivize all the affiliate company to work together to make the client happy instead of fighting for their pieces of the margin. If we go into the practical details, we have in slide 13 a very specific project. The project is named Project ABC. There is a cost structure, assuming that there are 10 of cost, 1 relating to design, 7 in relation to production, 1 in relation to installation, and 1 in relation to project management. So the project has 10 of cost. That is what is budgeted in the tender process. Assuming that the client won the tender process with a margin of 40%, that gives a margin of 4 that needs to be split between the value species of the enterprise. That's what you can see in the table on the right-hand side with project cost of 10, project profit of 4, and the project price of 14. All this would be perfectly fine and relatively clear in the absence of borders, in the absence of two affiliates contributing to the same project. We are getting now to the few steps of the application of the residual profit split method. I won't necessarily go into the details, but I'll provide the broad picture. We have here affiliate A, which has a cost structure that will need to earn a return through the charge of the transfer price for design, engineering, and project management services to affiliate B. Affiliate B also has a cost structure and needs to earn a profit in relation to its activities of production and installation. Affiliate B, remember, is charging prices to the clients. Only this step, which is the identification of the pie to be shared, is raising difficulties, and they are shown in slide 14 on the right-hand side. You have here the first point, which is the segmentation. The OECD has rightly identified that the profit split method needs, in fact, to be a transactional profit split method. So we are not talking here about the profit of the whole company. We need to segment out the profit in relation to project A, B, C. Second has also been identified by the OECD whether or not the pie that we need to share is a net profit or the gross profit. In the case at hand, we have the profit that the two companies are making in relation to the project, but this profit is actually a gross profit because a number of costs of the company, which are, for instance, R&D costs, admin costs, are not embedded into the management accounts of the company. So there is a need for reclassification. And there is a third question, which is a more fundamental question, whether profits that needs to be split are the budget profit or the real profits after the facts. So that's step one, what is to be shared. Step two is in the residual profit split method, and slide 15 involves the identification of what we call benchmarkable returns. So you first allocate a profit to what can be benchmarked, typically through benchmarking analysis. And this first step allows to limit or mitigate the amount of profit that will be subject to a split factor. In the case at hand, can you find design houses in the market that are doing design services? The answer is yes. Can you find their remuneration? The answer is yes. So yes, you can benchmark this activity. But this activity that you can find on the market does not entail the level of risk or the level of depth of integration with production, for instance, that your internal function would have. So that is a base remuneration for the design functional activities, but that's not the end of the story. That's not the end of what the design team needs to earn in the specific context of this company. Here you can see we assume 5% of cost for A. We also assume 5% of cost for simplification for B. That gives benchmarkable returns of 0.1 and 0.4 respectively. All numbers are really fictive. And that leaves a residual profit of 3.5, given that the total profit to be shared was 4 at the beginning. Few questions on the side. Does TNMM grasp all the value derived from benchmarkable routine function? The answer is yes, to the extent that comparables are good. Are there other methods that are available to set or price the remuneration of benchmarkable functions? The answer is yes. For instance, if you have in the company good technology, and if this technology can be benchmarked through, for instance, the comparable and controlled price method, this can be carved out from the residual profit so that the residual profit is smaller, and then the split factor applies only to this share. Last but not least, the step 3 on slide 16 involves the sharing of the residual profit. As Amanda has rightly described, this is not the easiest part. This is even the most difficult because you're splitting the unknown, I mean the residual profits that could not be attributable through benchmarkable functions. Here in the case at hand, we've made the assumption of a 50-50 split for the purpose of the case. The OECD has made a very strong preference for cost or investment-based factors, but indeed opens the door for other methods, such as the compensation data. but that will be surely subject to a number of discussions and possibly disputes between taxpayers and tax authorities. What is the relevant split factor in the case at hand? The last slide is the price setting. Once you've done all this process, you are in a position to allocate profits to the two companies based on a very detailed process that allows to set the price for the design, engineering, and project management services from affiliate B to from affiliate A to affiliate B. In the case at hand, it's 3.85, which is composed of the cost of affiliate A plus its benchmarkable return plus a share of the residual profit. Again, why does affiliate A deserve a residual profit? It is for the reasons that we've described before, that it is in a specific situation in terms of value contribution, intangibles creation, and risk sharing.
Maybe, Sebastian, let me ask one question to your profit split, because I appreciate now this has been kind of profit split based on price setting, not outcome testing, so in setting in advance. What happens now? We have set this transfer price at 385, and now what happens if in the course of the year company B encounters very difficult market circumstances and runs into a loss situation for reasons which may be beyond its responsibility or its fault, but it just happens. That's being the market and the business. And now we have allocated an expected residual profit to country A, and we have an actual big loss in country B. Is that going to be accepted by tax authorities?
That's also a very, very good question. And that's also a question that is discussed by the OECD in the latest final guidance on profit split, the difference between ex ante and ex post. The answer is the following. If we assume that we are right that the two companies can and should be held responsible for the upside and the downside of the project that can be relating to either internal factors or external, I indeed assume that there should be some form of ex post testing that the two companies are within the range of acceptable returns. So in your situation, there clearly should be a check to ensure that there is a form of sharing in case there are events that are outside of the responsibility of anyone. So that's one. Second, I believe, though, that there are certain circumstances or certain events, and that can also be contractually set, that are only in relation to the responsibility of affiliate A and affiliate B. So, in my view, the best approach is to contractually agree between the parties the circumstances in which there would be a renegotiation, to check and ensure that the ex post outcomes are within an acceptable range between the two companies. Because we assume here we are within a group that there is a form of cooperation, long-term relationship where one party indeed cannot make losses, huge losses in relation to the project for a number of years in a row without having the ability to renegotiate with the other affiliates.
Thank you.
So I'm going to talk about a financial services case now. This is the application of a profit split across the entire value chain. In the case study that we're going to be talking about is in the asset management sector. And just to give you a little bit of a brief overview of the transacting parties, if you have a look on slide 19, so you have the investors that ultimately would by the fund. The money of the fund is channeled through Luxembourg, so the management fees and administration fees for the fund is paid to Luxembourg, and that's your management company. Then you have the UK and Irish companies that host portfolio management functions. You've got the UK that also hosts some marketing functions and some fund design functions. And then you have Germany, France, Switzerland, Italy, and the UK potentially doing some distribution activity. Now, typically, just to give you a little bit of an overview of the asset management sector, you can have a value chain within the sector from one asset manager to the next asset manager that looks the same, but it doesn't necessarily mean that each of these functions contribute to the same amount of value to that particular firm. So a value chain is not stagnant. It would depend on the asset manager, on how they organize their business. So keeping this in mind, now how would we apply the profit split methodology? We'll typically start, as pointed out earlier, with your value chain analysis. So in this particular case, you have fund design and marketing, you have distribution and fundraising, you've got investment management and fund administration. All the full details of the value chain analysis, I won't go through it, it is on slide 20. So then you have your functions, assets and risk, and each of these value drivers has specific functions, assets and risk allocated to that. And then you can identify what is the potential cost. Now, as mentioned in this particular case, I'm going to show you how to apply a profit split method across the entire value chain. So this is the asset management value chain. Having identified this, your first step really is to identify, how to do it. What's the data that you will be working with? So first of all, we identify what is your routine functions, your benchmarkable functions, as mentioned earlier, and what is potentially your CURT, your key entrepreneurial risk-taking functions. Now, in this particular case, we've identified that you have potentially fund distribution and investment management and some marketing activity, all contributing to potential CURT activity, as well as fund design, and then the remainder being support activities. And within those functions, also in distribution and investment management, you also have certain support activities that would support that. So through your analysis, your value chain functional asset and risk analysis, you will be able to identify how this is organized within the group. And as mentioned before, it doesn't mean that one asset manager may have this profile, that the other one would have the same profile. So it's very much case specific that you need to consider this in. Through that analysis, you then identify potentially that your support functions relates to, for example, 350 or 450 in cost, and your important function, your CURT functions relate to 350 in cost. So that gives you a total cost of potentially 800. Your profit is 200, so your total revenue is 1,000. All this details is on slide 21, so I won't go into too much details on each of these entities. Now, a question is, how do we split the 200? So first of all, as mentioned, you've got your benchmarkable functions, so you can remove your routine remuneration by applying potentially through a benchmarking study. You determine it's a cost plus 10%, or you apply the TNMM and you determine what is the routine profits for your particular case. And in this case, we've applied the 10%. In this case, it turns out to be, for example, 45%. We're now on slide 22. Now the question remains, so having removed your or determined what your benchmarkable profits is and how that should be allocated across your various entities, what do we do with the 155 that remains? And that is always the key question. How do you split that amount? In this particular case, we've used compensation-based data. The reason why we've used this data is because this is an industry, and in this particular case study, it's know-how, it's people-driven. And there is not very much with respect to technology. Naturally, there is technology, but it doesn't provide a competitive advantage. So it's all about the know-how of the people and what they do. For these type of cases, using compensation-based data is very useful in that it provides the relative value contribution of that particular individual to the overall value creation process. A caveat that I would say when using compensation data is that it would not take into account any historical intangibles that would have been built, and it will also not take into account any long-term risk-taking that may have occurred within the organization. So that is on a case-by-case scenario. You would need to kind of consider what the history and what the investment was that was done to get to the point that you're at.
Amanda, if I may jump in, I have a question. What were the practical difficulties in the using compensation data for assessing the split factor in this specific case?
I think when it comes to using compensation-based data, given the sensitivity surrounding the data, actually collecting the data is quite complicated within a big multinational organization. The other thing is you using potential compensation based across a number of countries that works under different regulatory regimes and employment rules. So you need to truly assess how those individual markets work with respect to their employment and their compensation structures. And then also it's with respect to the cutoff, which level of staff in the organizations would you naturally consider as being the key individuals whose data you want to use. So that's from a practical standpoint, that's quite an in-depth analysis that you would need to make, and a lot of discussions with the group and the people in the business that you're working for. So on slide 24, having now identified the 155, our next step is now to ultimately split the residual profit using your compensation-based split factor that you've devised. And ultimately, using the staff costs, we've devised a split factor of 6%, 43 and 55 or 56% based on your compensation-based data. And then applying it to whatever the residual profit is, then gives you the allocation of profit allocation for each of the functions or each of the value drivers in your value chain. So this methodology can be used to both set as well as to test prices. As mentioned, I've explained this across the entire value chain. You will then you can take it one step further then to go and apply it by entity.
Amanda, if I may, you're describing the application of the profit split method for the asset management industry, while I think it's well known that there are a number of cuts comparable on controlled transactions. How do we reconcile the use of one method compared to the use of the cut method?
Okay. In this industry where CUPS is in fact, as you rightly point out, a very uncommon methodology that can be used, ultimately you can use both methods. And I have on slide 25 a practical example on the application of a CUP and how that potentially would compare to the profit split methodology. So if we, for example, assume that the admin fee remuneration is 20 basis points, which normally is applied to assets under management, your investment management fee is 70 basis points, which is normally applied to assets under management, and your distribution fee CUPS is, say, 1.10, which relatively apply to asset management. In this case, what the CUP-based remuneration would give you is 550, 350 and 100. 550 for distribution, 350 for investment management, and 100 for fund administration. Whilst your profit split methodology, as I've described earlier, would gives you an implied revenues of 565 and 347 for investment management and 88 for fund administration. So in this case, it's fairly close, but it does not necessarily mean it will be broadly consistent. There may be comparability factors either within your CUP or data issues in your profit split that may lead to diverging results. Naturally, a CUP is a fixed value, so there is certain things you need to account for that. But in practice, or well, in theory, I wouldn't say in practice, in theory, the two should be fairly close together when you apply that.
Thank you, Amanda. Well, the digital economy, though I appreciate that probably most of the people who are listening to are not part of the digital economy, they should probably be aware that at the level of their CFO or CEO, they are going to be part of the digital economy in a few years from now. So probably it's a case study that is going beyond the pure tech sector. And to set the ground a little bit, I've prepared a value network overview on page 27, and I think it's important that the people here can understand how this is structured, because you see a lot of very familiar brand names on that sheet, which means that though they may all be to some extent in a different business, they have all certain things in common. And the 4 building blocks of the digital economy are presented here, namely covering technology, users, advertisers, and business partners. So what are we consider as the key value drivers? Sorry. So what are we considering here? The platform technology can be anything like a search engine, an e-commerce platform, a social network, depending on the business. This is what drives at the origin. So the inventors of Silicon Valley at some stage have developed something very great, which has been they're building up something which has generated the interest of users. Technology has attracted users over time, and sometimes there are some business models where users who are interested in getting on that technology are willing to pay for that, but sometimes they get it for free because the tech companies have realized that they can earn their money with something else, namely by monetizing their user base in combination with their technological abilities. And this is, for instance, with some industries, so Google, Facebook, YouTube, name here, you earn your money with advertisers. Namely, through users being on the platform of technology, the users are willing to share their personal data and interests with a hosting network, and through that, the technology provider can help advertisers in this example to target their advertising in a specific way to achieve the maximum outcome in terms of user attention and attractiveness to click on certain ads, for example. And the better targeted certain things are, the greater the amount that advertisers are willing to pay. This is how some of these big players earn money. The others, Amazon or other Uber or what have you, they have different models, but still they earn money with other business partners. They can be industrial companies or other service providers who want to sell their services to users. And again, they use the fact that through the platform technology, they can have an effective access to those users. And again, they pay the tech companies for that kind of services. So very diverse models, but very often the same, ultimately the same big elements in terms of what drives the business and what drives the value of the business. And this sets the ground a little bit for the question, okay, when now within a tech company, functions are spread across the globe, which value do I attribute to what function? And this leads me to the next slide. So if we go on page 28, you have here a stylized value chain breakdown that goes across functions and which it goes across regions or countries. And in that functional analysis, in principle, there are 3 major building blocks to make. The first is the very traditional transfer pricing approach from all of these functions in the value network, which are the ones that I can carve out as being more routine type, benchmarkable. Yeah? In this slide, it is assumed that it is functions related to so-called data centers. So data centers are the IT infrastructure that enable tech players to serve their users and clients across the globe. The second is local sales support, marketing activities. We'll touch that later again. The second dimension is then what's remaining. Yeah, and this is, and here we have split it in two blocks at the bottom end of the slide. So on the dimension fray, technology on the one hand, because ultimately these digital players are considered as tech companies. So technology is probably an important part of their value proposition. And second, everything that is more user-based or advertiser-based or business partner-based relations. So something with relations with people or other organizations. So the two building blocks. So the question that is the heart of any transfer pricing solution for a tech company is especially this dimension. We will deal with that later. And then there is the third dimension, within a vertical column of certain, for example, user or advertiser and business partner relationships. Functions may be spread across the globe. There may be certain central functions at headquarters. There may be regional headquarters with certain functions, and they may do certain same things. They may share certain kinds of work. So the question is now, if we say there is a part X of residual profit which belongs to user base, business partnerships, etc., how do we split up that piece of the pie to the individual companies which contribute to that effort? And this is, I think, the more traditional question, which relates to what the OECD comes now to the DEMPI functions, namely who on this vertical last column, who contributes what regarding the development, enhancement, protection, exploitation of intangible value drivers. We'll not deal with that issue. We will deal primarily with a second element here in our case study. So the questions, the transfer pricing questions that we were facing here with a major digital company was, what kind of economic analysis do you propose to split up residual profit between technology-based intangibles on the one hand and all the other intangibles on the other hand? And that was quite challenging, because this business qualifies very much what the OECD describes as a business, where the value contributions can only be separated in a very difficult manner, because you don't know for sure whether a user buys something or an advertiser buys you for the user or for the tech or whatever. You have a chicken and egg problem in this industry, which is really systematic. This being said, chicken and egg is obviously a great challenge for economists, and to solve the issues, we found out that these questions can really be dealt with in an elegant manner by talking to the data analytics experts within the company. Because like we were asked to think from a tax perspective, what's the fair allocation of profit? Within the technical company, top management wants to know exactly, for their business development purposes, how do we enhance the value from our technology, from our user base, to increase our business. So they have a lot of people, dozens, hundreds of people who deal only with that question. And what they are doing in trying to assess what drives what, they do what they call certain types of experiments. So if you have a two-dimensional value creation network technology on the other hand, and value and business partner relationships on the other hand, you ask what would be, for example, in experiment 1, what would be the impact on the your incremental revenue impact if you were not applying the most sophisticated technology solutions, for example, to your advertising campaigns. Yeah. So if you were less targeted in approaching certain users, you do not apply the maximum know-how you have in one sector. And they do these kinds of experiments from time to time, and then they see, oh, this is the incremental impact. Our revenue drops by so much per user, for example, because you get revenue only if users are interested in what you're advertising. Advertising becomes less targeted, revenue drops down. From this you can derive what's the marginal impact of technology. Same experiment is, or opposite experiment I should say, number 2 is you start an experiment where you do not use all the user data you have available in your database, because user data goes obviously becomes beyond names and addresses. It goes everything that is document tracing, interests, buying patterns, or what have you. You take out certain information that you do not share, and then you see how less effective your technology solution become. And from this you can derive again what's the marginal impact of having a very sophisticated, extensive user base information. Yeah. So what this exercise does basically is really, from a contribution perspective, trying to isolate the impact factors of different value drivers. And the good thing is, you have to dive deep with the business analytics people in the digital company, but they have this kind of information or can generate it simply because it also fits in their business interest. A third experiment is a kind of survey, so that's also done constantly from a business point of view. Why are people going on a certain platform? What's driving their interest? What are they paying for? Again, you can derive willingness to buy, willingness to pay on an isolated basis. And this kind of marginal contributions is then in principle gives you the profit split between the two categories of intangible assets. Yeah? Based on client-specific internal data. And when we see here on the slide that we're talking about a quantitative validation, this is only a reflection, this profit split, that is outcome of this contribution analysis, is only a validation of what you described early onwards as a bargaining approach in transfer pricing. Two types of intangible owners negotiating a hypothetical outcome, how they would share profits. Each of them knows what his or her marginal contribution to the profit is, and very naturally, this marginal contribution knowledge translates into the profit split. Yeah. So that is a little bit the kind of expertise. So if we contrast this, for example, with the two earlier examples of traditional industry or financial sector, we have very different solutions in that particular case. Namely, to say, well, when you compare something technology-based, where there's various information about users, advertisers, business partners, costs, or any balance sheet item is not a real good proxy for measuring relative value contribution. Not at all. The core thing is really company data, and the good thing, and that is maybe also then for many of those who are listening here in the future, data gathering becomes ever more important across industries. Business decision makers are interested to understanding why are people buying certain products with certain features. All of these kinds of information are gathered, and with the always increasing productivity in terms of artificial intelligence whatsoever, the number crunching exercise becomes ever more simple to find the origins of value. And this is why I think this industry is really a big enabler for future profit split solutions also in other industries.
Just a question to track back a little bit about user value. How do you perceive relative value of users in comparison to business partners and advertising partner relationships? If we track back a little bit to slide 27.
I think that's probably the truth, or the greatest element of truth, because being transfer pricing, there is no absolute truth to that, and you can always twist certain arguments. But the interesting thing is, why have users becoming users? They were attracted by the baseline technologies that were provided by the tech companies, a search engine, or an e-commerce platform. That what drives their value, that gives them choice, that gives them the ability to express themselves, that it gives them the ability to find the things they are looking for. And advertisers become interested in that business because they say, oh, these tech companies have a lot of user data. And maybe they can help us target our advertising. Or business partners of Amazon knows they work together with Amazon because Amazon will give them the best finds and the best client base and the most targeted interests in terms of consumers. And this is why, advertiser relations, business partner relations become more important over time as the business evolves further and further. So all these tech companies whose names I've just mentioned, they're expanding their business, going away from their traditional only thing model. They're doing something else. They are building up new businesses, for example, as a tech advisor to a business partner, and trying to generate new business models, and as this becomes more important, these business partner and advertiser relations become ever more important, because but at the end, these partners and advertisers are only there because the tech companies have this kind of user base.
That's very interesting. In just a follow-up question on that, in your functional value breakdown, you consider local sales activities as routine, whereas the users are in fact owned by the regional hubs. Given that the users are based in the local country, why should they not be intangibles for the local companies?
Amanda, I think you're touching a point at which every European government is trying to find an answer to, and in a communication process with their own electorate. It's a very natural question. I think the technical transfer pricing answers is straightforward. It is because the sales companies, in the cases that I'm aware of, hardly have any relationship with their user base. So in our TP slang, they conduct no DEMP functions, or only very limited, if at all, DEMP functions when it comes to growing their local user base, because the user base, as a German, I'm not going on Google for my search, because Google has a German subsidiary, that is attracting me. It's not a personal marketing issue. I go there because I'm aware that the Google network exists somewhere. This is what drives me there. And so user base related DEMP functions can and are to a large extent centralized in certain locations within the group, and not spread over territories. And that's tax following business should also then be considered in normal transfer pricing analysis. We all appreciate that in the current discussion about digital taxation, yeah, still not off the table as at the time of where we're discussing this here. This is a very big political discussion, and we know that all these tech companies have difficulties negotiating certain tax audits, yeah, especially in Western and Southern Europe. Yeah? But the fact is, as long as we stick to transfer pricing principles, there is a lot of good arguments to say why the local activities on the ground are of more limited importance, when it comes to overall value generation. I think I've already summarized a little bit the key elements of this case study. So maybe, Sebastian, short, concise summary of the overall insight that we tried to share with the audience today.
Yes, thank you, Yves, and thank you, Amanda. A few concluding remarks. I think the cases showed a wide variety of applications of the profit split, and the primary application is when there is a joint value creation by individual entities within a group. We've also shown that the selection of the method should be grounded into a holistic understanding of value creation, and specifically how individual entities are contributing jointly to the relative value creation. A third point, which is not the least, is that profit split is not global formulary apportionment, meaning that when a method is applicable, it needs to go through a certain process which is primarily grounded in economics, and it's not a global apportionment of profit that is at stake here. It's one of the selected OECD method. The split factors are clearly extremely important in terms of their selection and the application. And finally, like in any application of a transfer pricing method, it can be used as part of a budget process to set prices, but then comes the question about possible balancing payments or adjustments in case the ex post outcomes are not in line with the ex ante applications. Overall, and in light of the latest OECD guidelines, we don't necessarily see a huge wave of profit split method, but it's likely that, especially in light of the digital economy wave, there is an increasing use of the profit split method, and we hope that this webinar will help practitioners, both from the tax authorities, international organizations, and companies, to better be in a position to apply it based on these real cases examples. Thank you very much on behalf of Yves, Amanda, and myself. We are very pleased, and we'd like to thank also Informa and the TP Minds team for the nice invitation.
Thank you. We are now happy to take any questions that you may have, so please keep them coming. We'll try and address as many of them as possible.